The recent Israeli airstrikes on Iran have sparked significant geopolitical tensions, leading to a widespread impact on global financial markets. Gold prices surged to nearly $3,450 per ounce as investors sought safe haven assets amidst fears of escalating conflict. This rise in gold reflects its traditional appeal during times of uncertainty, with analysts predicting potential new highs if tensions continue. Concurrently, global stock markets, including major indices like the FTSE 100, DAX 40, and CAC 40, experienced declines, highlighting investor caution. In the United States, stock futures fell sharply, with the Dow Jones Industrial Average futures dropping by 423 points, while the S&P 500 and NASDAQ 100 futures also saw significant declines. The energy sector, however, saw gains as oil prices surged over 8% due to concerns about supply disruptions, with West Texas Intermediate crude nearing $74 a barrel. This spike in oil prices poses broader implications for inflation and could complicate monetary policy decisions by the Federal Reserve. The geopolitical developments also affected Indian equity markets, with the BSE Sensex and NSE Nifty 50 both declining. Despite the downturn, companies like Tech Mahindra and Tata Consultancy Services recorded gains, while sectors sensitive to logistics costs, such as Adani Ports, faced setbacks. The broader market sentiment remains fragile due to fears of renewed inflation and potential interest rate hikes, despite India's CPI inflation staying below the central bank's comfort zone. As the situation evolves, investors and market participants are closely monitoring geopolitical developments, energy prices, and economic indicators to assess their impact on inflation, monetary policy, and overall economic stability.
Walmart Inc. and Amazon.com Inc. are reportedly exploring the issuance of their own stablecoins, as detailed in a recent Wall Street Journal report. Stablecoins are digital currencies pegged to fiat currencies like the US dollar, designed to maintain a stable value through reserves of cash or cash-equivalent assets. This potential move by the retail giants could significantly disrupt traditional financial systems by shifting a considerable volume of transactions away from conventional cash and card systems, thereby saving on transaction fees. The decision to proceed with stablecoin issuance is contingent upon the passage of the Genius Act, a proposed regulatory framework for stablecoins, which is currently awaiting approval from the Senate and the House. The exploration of stablecoins by Walmart and Amazon signifies a growing trend in the retail sector towards digital currencies, as evidenced by Shopify Inc.'s recent partnership with Coinbase Global Inc. to accept USD Coin, USDC, a major stablecoin. This shift underscores the increasing traction of stablecoins, with Treasury Secretary Scott Bessent predicting their market capitalization could surpass $2 trillion. However, despite their potential benefits, stablecoins face ongoing scrutiny over security and regulatory challenges. In related developments, Uber's CEO announced the company is assessing the feasibility of accepting stablecoins, reflecting broader corporate interest in digital currencies. Meanwhile, Walmart and Amazon stock performances have diverged this year, with Walmart up 5.37% and Amazon down 3.17%, according to Benzinga Pro data.
The recent report by the Ludwig Institute for Shared Economic Prosperity, LISEP, highlights a significant decline in American spending power, revealing that most households fall short of affording a minimal quality of life. The study introduces a new minimal quality of life index, which goes beyond basic survival needs to include costs associated with a middle-class lifestyle, such as occasional dining out, leisure activities, and saving for future expenses like education. According to LISEP, the bottom 60% of U.S. households by income have not kept pace with rising costs, as wages have stagnated while essential expenses such as medical premiums, rent, and travel have soared by 301%, 131%, and 170% respectively from 2001 to 2023. This financial strain could lead to increased debt levels and hinder long-term financial planning for many Americans. The report suggests that individuals focus on reducing major expenses, housing, transportation, and food, while also seeking ways to boost income. The broader economic implication is a potential shift in consumer behavior, with reduced discretionary spending impacting sectors reliant on middle-class consumption. Policymakers and financial advisors may need to address these challenges to support upward mobility and economic stability.
Israel has ordered the temporary shutdown of its largest natural gas field, Leviathan, due to heightened security concerns following recent geopolitical tensions. This decision comes after Israel's military action against Iran and subsequent threats of retaliation from Tehran. The shutdown, mandated by Israel's energy ministry, also led to Energean plc halting production at its Karish field. The Leviathan field, operated by Chevron Corp., plays a crucial role in supplying natural gas to Israel and neighboring countries like Jordan and Egypt. The suspension is expected to disrupt regional gas supplies, particularly impacting Egypt, which is experiencing increased demand due to summer heat. The immediate consequence of the shutdown has been a noticeable uptick in gas prices, with European markets experiencing a rise of up to 6.6%. This development could compel Egypt to accelerate its LNG purchases, thereby further tightening the global gas market. The situation underscores the vulnerability of energy supplies to geopolitical instability, particularly in regions with significant energy infrastructure. As the situation unfolds, market participants will be closely monitoring any further developments or statements from key entities like Chevron and Israel's energy ministry, as well as potential impacts on global energy prices and supply chains.
Friday's analyst calls featured significant attention on major tech firms, with notable endorsements for companies like Nvidia, Adobe, and Microsoft due to their strategic positioning in artificial intelligence, AI. Mizuho reiterated Nvidia's outperform rating, emphasizing its leadership in AI, bolstered by its CUDA platform. Meanwhile, Goldman Sachs maintained a buy rating for Adobe, citing its AI momentum post-earnings. Wells Fargo's upgrade of Microsoft's price target to $565 underscores the company's dominance in AI, leveraging its comprehensive suite of AI services across hardware, infrastructure, and software. Tesla also received a positive outlook from Morgan Stanley, which highlighted the company's strategic advantages in data, robotics, and AI. On the other hand, Wolfe downgraded GE Vernova based on valuation concerns, while Citi expressed caution about Sherwin-Williams, downgrading it to neutral due to a challenging housing market. These analyst calls reflect a broader market focus on AI capabilities and strategic positioning, influencing stock valuations and investor sentiment across various sectors.
Barclays analysts have identified a potential turning point for the S&P 500, suggesting that the current valuation of 22 times next 12-month NTM earnings might not be a significant barrier to further equity upside. Historically, when the S&P 500's price-to-earnings (PE) ratio has crossed the 22x threshold, the market has often experienced improved returns, particularly following rapid sell-offs and V-shaped recoveries. As seen in 1998 and 2020, this pattern indicates that a PE ratio in this range could signal a capitulation of bearish sentiment, potentially igniting a rally driven by investor optimism or animal spirits. Despite this optimistic outlook, Barclays warns of potential volatility in the near term due to uncertainties surrounding U.S. fiscal policy and anticipated impacts from tariffs on second quarter 2025 earnings. Nonetheless, the analysts argue that current valuations should not be viewed as a ceiling, especially if earnings growth aligns with their forecast of approximately 9% in 2026. While challenges such as fiscal constraints and tariffs exist, Barclays maintains that the current market valuation does not preclude further gains, provided earnings growth remains robust.
Finance Minister Nirmala Sitharaman is set to meet with the heads of public sector banks, PSBs, on June 27, following the Reserve Bank of India's (RBI) unexpected monetary policy adjustments. The RBI's Monetary Policy Committee, led by Governor Sanjay Malhotra, implemented a significant 50 basis point cut to the benchmark repo rate, reducing it to 5.5%, and decreased the cash reserve ratio by 100 basis points to 3%. This move is intended to inject 2.5 lakh rupees crore into the banking system, aiming to stimulate lending and economic growth. The finance ministers' meeting will focus on reviewing the bank's financial performance and their role in executing government schemes, such as the Kisan credit card and various social security initiatives. Public sector banks have reported a record cumulative profit of 1.78 lakh rupees crore for the fiscal year ending March 2025, marking a 26% increase from the previous year. The State Bank of India (SBI) was a major contributor, accounting for over 40% of the total profits with a net profit of 70,901 crore rupees, a 16% rise from the prior year. Other banks like Punjab National Bank and Punjab and Sind Bank also showed significant growth in net profits at 102% and 71% respectively. The upcoming meeting is crucial as it will likely address strategies for further boosting lending in productive sectors to counteract the current economic slowdown, with growth at a 4-year low of 6.5% in FY25.
In Friday's pre-market session, U.S. stock futures saw a significant downturn, with Dow futures dropping over 500 points. Adobe Inc., ADB, was among the notable stocks moving lower, despite reporting strong second-quarter financial results. The company posted a revenue of $5.87 billion, exceeding analyst expectations of $5.79 billion, and adjusted earnings per share of $5.06, surpassing the anticipated $4.96. Despite this positive performance and an upward revision of its fiscal year 2025 guidance, Adobe's shares fell 1.8% to $406.55 in pre-market trading. This decline in Adobe's stock, along with other major stocks, reflects broader market sentiment rather than company-specific weaknesses. The downward trend in futures suggests investor caution, potentially driven by macroeconomic concerns or profit-taking activities. Such movements can impact market strategies, prompting investors to reassess positions in technology stocks that have shown resilience amid economic uncertainties. As Adobe's performance remains strong, the dip could present a buying opportunity for investors confident in the company's long-term growth trajectory.
As of June 6, 2025, India's foreign exchange reserves have increased significantly by $5.17 billion, reaching $696.66 billion, according to the Reserve Bank of India (RBI). This growth brings the reserves within 1.2% of their all-time high of $704.89 billion, recorded in September 2024. The increase is primarily attributed to a $3.472 billion rise in foreign currency assets, now totaling $587.687 billion, which are influenced by exchange rate movements of major currencies like the euro, pound, and yen. Additionally, India's gold reserves grew by $1.58 billion to $85.89 billion, reflecting a global trend of central banks bolstering gold holdings as a safe haven asset. The special drawing rights, SDRs, and India's reserve position with the International Monetary Fund, IMF, also saw modest increases. This expansion of Forex reserves is a strategic effort by the RBI to enhance economic stability and manage currency fluctuations, providing a buffer against external economic shocks. RBI Governor Sanjay Malhotra has assured that the reserves are sufficient to cover 11 months of imports and about 96% of the country's external debt, highlighting India's strong economic position. The current reserve levels are expected to positively influence market sentiment, reinforcing confidence in India's economic resilience amidst global financial uncertainties.
HSBC's recent report forecasts that India's inflation rate will average around 2.5% over the next 6 months, significantly lower than the Reserve Bank of India's RBI projection of 3.5%. This optimistic outlook is attributed to a high base effect from the previous year and a continued deflation in food prices, which have fallen for the 5th consecutive month. Although vegetable prices have shown a slight increase in early June, the overall trend remains favorable due to robust cereal production and strategic stock management by the government. This scenario presents a positive outlook for India's economic stability, with inflation figures well below the central bank's target of 4%. The report also highlights that while gold prices have surged by over 30% recently, contributing to elevated core inflation figures, the exclusion of gold from calculations shows a more tempered core inflation rate of 3.5% year-on-year. Looking forward, HSBC anticipates that core inflation could decline if gold prices drop as predicted in the second half of 2025. Additionally, a stronger Indian rupee and falling commodity prices, coupled with imported disinflation from China, are expected to keep inflationary pressures subdued. The RBI's monetary policy has already seen a 100 basis point reduction in interest rates this year, with HSBC predicting a further 25 basis point cut by the end of 2025, potentially bringing the repo rate to 5.25%. These developments suggest a stable economic environment for India, with potential positive implications for market sentiment and consumer purchasing power.